So your restaurants are thriving with healthy profit margins, and you're ready to expand beyond bootstrap growth. Welcome to your restaurant expansion funding journey, where we'll navigate the crucial decisions between debt, equity, and everything in between. You've cracked the code at your existing locations, generating 15 to 30% store level profit, but expansion requires capital, often more than you can bootstrap alone. Today, we're building the strategic roadmap to scaling your success without breaking what works. Here's the moment that separates dreamers from doers: accurately calculating your true funding needs. Guessing wrong doesn't just waste legal fees, it destroys your credibility before you even begin. Most plans fail because they treat funding like getting enough to open the doors, but they forget the working capital reserve. You need 3 to 6 months of operating expenses in cash to sustain a new location until it stabilizes. Add a 10 to 20% contingency buffer, because projects always cost more and take longer than expected. The fundamental viability check is your sales to investment ratio. If your projected sales aren't hitting at least a 2-to-1 ratio with total investment, ideally 3-to-1, funders won't be attracted to the deal. Pure bootstrapping becomes a bottleneck while competitors race ahead with external capital. Without a systematic framework for sales to investment ratios and debt to EBITDA multiples, restaurateurs either can't secure funding or they accept deals that fundamentally undermine their long-term wealth creation. Now we architect your expansion's financial backbone using the 70-30 debt to equity golden ratio. Financing roughly 70 to 80% of the project with debt tends to maximize your ROI while maintaining control. However, the debt must be survivable. Your projections should land in a debt to EBITDA range of 2 to 5, and your EBITDA should cover interest expenses at least 5 times over. Watch as we balance the quick ROI of debt against the partnership of equity to find your growth appetite. Choose your equity universe: short-term unit-level deals or long-term empire building. Monthly investors usually want quick returns via a preferred distribution waterfall. They get 80 to 100% of distributions until they hit 120% payback. Then the split flips in your favor. Conversely, long-term investors bet on the brand's appreciation, often targeting a private equity exit once you hit 10 to 30 locations. The critical insight: your investor type must match your growth strategy, or you'll face misaligned incentives. Arm yourself with the complete debt arsenal. Many expansions default to SBA 7A loans, offering 10-year terms, low rates, and flexible use of funds, though they require personal guarantees. For real estate, the SBA 504 offers fixed rates over 25 years. Don't forget creative tools like tenant improvement allowances, equipment financing, and lines of credit for that final finish line cash. Lenders are underwriting your planning discipline. They want to see that your existing stores can carry the load if the new one ramps slowly. This is the fundamental shift. Expansion funding isn't found, it's earned. The old mindset was a choice between growing slowly or giving away the farm. The new paradigm recognizes that strategic capital structure is a competitive advantage. When your financial reporting is bulletproof, you transform from a capital seeker to a deal maker. You can expand 3 to 5 times faster than bootstrap competitors while keeping your IP protected and your ownership dominant. Your track record becomes the leverage that fuels your next 10 locations. You now hold the complete expansion roadmap. Validate your unit economics, calculate the total need with reserves and buffers, choose the right debt equity mix, and secure the right partners. The restaurant empire you've envisioned is financially engineered for success. Your next move is to perfect your financial reporting so your numbers tell a compelling story. Connect with Force for the experienced accounting professionals your restaurant needs. Details in description below.